Welcome to the Deep Dive, the Talk Tickers edition. We filter through that fire hose of earnings info to get you what really matters.
Yeah, we try to cut through the noise.
And today we're digging into WaFd Inc, or WaFd, their Q4 and full year fiscal 2025 earnings call.
Right. And this wasn't just your standard quarterly update. It felt much more like a major strategy announcement.
How so?
Well, the headlines, they showed a bit of a miss. And the stock reacted initially.
Yeah, dipped after hours.
Exactly. But then during the call itself, management laid out this whole new vision, this big shift. They're calling it Build 2030. So you really have to look past those immediate numbers.
Okay, interesting. So let's start there with those mixed headlines. Just reading the initial release, it looked, well, a bit soft against the street's expectations.
Yeah, it did. GAAP EPS came in at 0.72 cents. Consensus was 75 cents.
So slight miss.
A slight miss there. And revenue was similar, $188.3 million. That was about 1% shy of what analysts were looking for.
And for the full year?
Full fiscal year, they reported EPS of $2.63.
Okay. So that explains the initial pressure on the stock, but you said the tone shifted during the call. What turned that around? What was the key thing?
It really came down to the net interest margin, the NAM, and growth momentum.
Right, the NAM. Always critical for banks.
Always. So the Q4 NIM itself was 2.71%. That's, only up 2 basis points from Q3. Modest.
Okay, not huge in itself.
Not huge. But the key detail, the real signal, was the exit spot rate at the end of the period. That was 2.82%.
Okay. So finishing stronger than the average for the quarter.
Exactly. That's an 11 basis point pickup between the average and the exit rate. It's management basically signaling, hey, margins are trending up nicely as we head into the next fiscal year.
And that flowed through to net interest income, the NII.
It did. NII was up $1.9 million compared to the prior quarter.
And how did they manage that lift? Was it assets or liabilities?
It was mostly on the liability side. Better liquidity management. Basically, the interest they paid out on deposits and borrowings fell faster than the interest they earned on their assets.
Makes sense. Did they give specifics on managing those liabilities?
Yeah, they did. They confirmed they'd spent the whole fiscal year intentionally running off about $1 billion of high-cost deposits.
$1 billion? From where?
Specifically from the Luther Burbank acquisition. Those were more expensive funds.
Got it. So cleaning up the funding base, did that make a real difference to their costs?
It seems so. They said running those off cut the remaining weighted rate on those specific deposits by 90 basis points. That's pretty significant.
Definitely. Swapping out expensive money for cheaper sources.
Right. And at the same time, they saw some okay growth in non-interest-bearing accounts, up about 3.2% year over year, which ties into their longer-term plan.
We'll get to that plan. But first, that funding stabilization, that should free up capital to deploy, right?
Oh.
Did we see that show up in loan production? Because those numbers look dramatic.
Explosive is probably the word. Yeah, this is where you really see that inflection point, that strategic shift starting. Active loan originations for the quarter hit $1.4 billion.
Wow, $1.4 billion. What was that compared to the previous quarter?
It was a massive jump, up 103% from the $700 million they did in Q3.
Okay, double the production in one quarter. Now you see numbers like that, especially now, and you immediately think, are they chasing risk? Where did that growth come from?
Good question. C&I, commercial and industrial production, was up 56%. Strong. But the really eye-popping number was commercial real estate, CRE. That surged 380% quarter over quarter.
Right, 380% in CRE, that's the number that raises eyebrows. Did management talk about underwriting standards with that kind of growth?
They did. They were pretty quick to emphasize that this growth came while sticking to their, quote, moderate risk profile and disciplined underwriting.
Okay.
But their explanation is that they're actively shifting away from those low-yield legacy loans we mentioned, mainly residential stuff, and putting that capital to work in higher-yielding commercial assets. So this surge reflects that pivot. It suggests their pipeline for new commercial deals is really filling up.
Okay, makes sense in that context. Let's switch gears to credit quality then. Still the number one concern for basically all regional banks right now. The headline numbers looked a bit worrying.
Yeah, on the surface, they definitely needed some explanation. Non-performing assets, NPAs, they ticked up to 0.54% of total assets. That's up from 0.36% the previous quarter.
That's a noticeable jump.
It is. And delinquent loans showed a similar trend, rising to 0.60% from 0.26%.
Okay, so clear increases there. What was the story behind that deterioration?
Management was very specific here. They said the increase was Largely driven, though not entirely, but largely driven by one single commercial real estate loan tipping over 90 days past due.
One loan. That moved the needle that much.
Apparently so. And they gave the adjusted number. If you strip out that one specific loan, NPAs would have been basically flat quarter over quarter back at 0.36%.
Okay, that's crucial context. So less of a widespread issue, more of a single, perhaps idiosyncratic problem loan.
That seems to be the message they wanted to convey. Now, obviously, the size of that one loan still highlights concentration risk, which is always a factor. But the overall provision for credit losses was still pretty modest at just $3.0 million for the quarter.
Implying they don't see systemic rot setting in?
Exactly. It suggests they view the core portfolio as stable and this event as more isolated.
All right, let's pivot then to the big picture, this Build 2030 strategy. You said this call was really about launching that. It's a shift from being a traditional thrift to a full commercial bank. What's the core problem they're trying to solve?
It really boils down to profitability and the valuation gap that comes from it. Management was quite frank, actually. They noted their returns are lagging significantly behind their mid-sized bank peers.
How much of a lag are we talking?
Pretty substantial. They pointed out the peer group return on average assets, ROAA, is around 1.22%. WaFd's is only 0.91%. That's a big difference in banking.
Yeah, that's significant underperformance. And they blame their thrift heritage. What does that actually mean structurally?
Yeah, the thrift heritage.
Yeah.
Basically, it means they historically relied on two things that are now dragging them down. First, a larger chunk of higher cost time deposits, CDs and the like, expensive funding.
Right.
And second, their loan book is heavily weighted towards those lower yielding single family residential mortgages. Think plain vanilla home loans.
Okay. So Build 2030 is about shedding that legacy.
Pretty much. It's like an internal restructuring to remake the balance sheet and hopefully get their profitability up to peer levels.
So if we're tracking the success of this plan over the next few years, what's the single most important metric to watch?
For me, it's all about the funding mix. The number one goal they stated is boosting non-interest bearing deposits, think free checking accounts, as a percentage of total deposits.
Where are they now and where do they want to get?
They're currently around 12%. The target is to get that up to 20% by the end of fiscal 2030.
Okay, a significant jump. How do they plan to get there?
Primarily by focusing intensely on growing small business banking relationships. Those businesses tend to bring in the sticky, non-interest bearing transaction accounts that banks love.
That makes sense. And that funding shift supports a huge change on the asset side too, right? Specifically around that big single-family mortgage portfolio.
Absolutely. This is a major move. They are officially exiting the business of originating single-family mortgages.
Exiting
originations, yes.
Yeah.
The existing portfolio, which is massive, about $8.1 billion.
Wow.
Yeah, $8.1 billion. It makes up roughly 40% of their entire loan book right now. And the yield on it is only about 4.2%.
So 40% of their loans are low-yielding residential mortgages they no longer want to originate. What happens to that $8 billion?
It's now considered inactive. They expect it to run off naturally. People refinance or sell homes at a rate of about $200 million to $300 million per quarter.
Okay, so it shrinks steadily. What's the strategic play there? Why actively shrink almost half your loan book?
It's about de-risking and improving yield simultaneously. The capital that gets freed up as those mortgages run off isn't just sitting idle.
Right. Where does it go?
They plan to redeploy it primarily into agency mortgage-backed securities, or MBS.
Okay, agency MBS. Why those?
Two key reasons. First, yield pickup. They estimate swapping the SFR loans for agency MBS gives them about 100 basis points, or 1% of extra yield.
So more income?
More income. And second, crucially, zero credit risk. Because agency MBS are backed by Fannie Mae or Freddie Mac, essentially government-backed.
Okay, so they're swapping potential credit headaches from individual mortgages for government-guaranteed securities that actually yield more.
Exactly. It's a significant de-risking move while also boosting income. A pretty powerful signal to the market about becoming more defensive.
Very interesting. So the balance sheet gets safer, higher yielding in that part, but they still expect growth overall.
Yes, but focused growth. In the active parts of the portfolio, the C&I and CRE segments, they do want to grow. They're projecting pretty strong growth, 8% to 12% for the next fiscal year.
So shrinking the low margin stuff, growing the higher margin stuff. Makes sense.
That's the plan. Strategic reallocation.
Beyond the core lending and funding, did they talk about other ways to make money, non-interest income?
They did. Diversifying revenue is clearly part of Build 2030. They launched WaFd Wealth Management.
Wealth management, okay. Any targets there?
Ambitious ones. They're aiming for $1 billion in assets under management. AUM within just 2 years.
That's aggressive.
Very. And they also got their preferred SBA lender status. So they're expanding into SBA 504 and 7A loans, which is another good source of fee income.
Well, what about technology? I saw a mention of Pike Street Labs doing in-house tech development.
Yeah, that's kind of interesting. It's a bit different from peers who might just buy off-the-shelf tech. They are investing in building their own stuff.
Does that cost more upfront? What about the efficiency ratio?
It probably does contribute to investment costs. Their efficiency ratio was a bit higher this quarter, 56.82%. But the idea is long-term control and maybe even unique features.
Like what? Any examples?
They mentioned things like building their own direct deposit switching tool and mobile wire transfers that can be verified by the customer's voice print.
Voice print verification for wires. That's neat.
Yeah, they mentioned potentially charging a $10 fee for that mobile wire service, so turning an internal tech capability into a direct revenue stream.
Interesting angle. Okay, let's tie all this strategy back to the stock and the investor. WaFd has really lagged its peers over the last year or so. Did management talk about that valuation gap?
They absolutely did, addressed it head on. They pointed out the stock is trading below tangible book value.
Which is unusual for a healthy bank.
Right, especially when they noted their mid-sized peers are trading around, say, 1.35 times tangible book. They clearly see that gap as too wide, as irrational, given the strategy they just laid out.
So if they think the stock is cheap, what are they doing about it? Capital allocation?
Buybacks. The CEO was explicit. Given the stock price, it was around $27.86 when they were talking. They intend to be active with their share repurchase program.
Buying back shares below book value is usually a good sign.
Yeah, they basically said it's the best use of capital right now. Buy the dip, essentially, was the vibe.
What about M&A? Are they looking to buy or sell?
They view consolidation favorably for the industry, but they signaled WaFd is unlikely to be a major buyer right now. 2 reasons. They have a pending appeal related to their CRA rating, and, well, their stock price is low. Hard to buy others when your own currency is depressed.
Makes sense. Okay, one last point from the call. The CEO is involved with the Mid-Sized Bank Coalition and talked about regulation.
Yes, and this is important context for all regional banks. He spoke pretty passionately about needing deposit insurance reform.
What specifically are they pushing for?
It's a big ask. They're advocating for $10 million in FDIC coverage, specifically for non-interest-bearing transaction accounts held at mid-sized banks.
$10 million, up from $250,000. Why?
The argument is about leveling the playing field with the giants, the too-big-to-fail banks. Those big banks benefit from an implicit guarantee, meaning large depositors feel safer there, even above the official FDIC limit.
So mid-sized banks lose out on those big operational accounts from businesses?
That's the claim. They argue this concentration of deposits in the largest banks is actually a systemic risk itself. Giving mid-sized banks higher coverage on these specific non-interest-bearing business accounts would, in their view, reduce deposit flight risk and let them compete fairly for core business relationships.
Was that realistic politically?
It's definitely an uphill battle, complex stuff.
Right.
But the fact that coalition leaders are pushing it so hard shows just how much pressure mid-sized banks feel about deposit stability post-SVB.
Got it. So summing up the whole call then, the message seems to be don't fixate on the slight Q4 miss. Focus on the stabilizing margin, the booming loan production engine.
Right.
And most importantly, this big strategic overhaul, Build 2030, as the path to closing that valuation gap over the long haul.
That's exactly it. It's a pivot story now, much more than just a quarterly earnings story.
All right, perfect time for our favorite segment. This is not financial advice. Given everything we've heard, especially the de-risking, that SFR to MBS swap, the buyback commitment, what's your outrageous but plausible trade idea for WaFd?
Okay, well, any trade on a regional bank feels a little outrageous right now, let's be honest.
Yeah.
The uncertainty is still high.
Fair point, but lean into the plausible side based on their specific actions, relative value maybe.
All right, here's the pitch. It's a pairs trade. You sell short a small basket of other regional banks.
Which ones?
Ones that are maybe more exposed, more geographically concentrated in tougher markets. Think Pacific Northwest peers with known exposure to challenged CRE or multifamily assets.
Okay, short the neighbors with potentially bigger headaches. And the other side of the pair.
You go long WaFd, a full position.
So betting WaFd outperforms those specific peers. What's the rationale? Why will WaFd win that matchup?
You're betting on 2 things, really. First, WaFd's history. They tend to have a more conservative credit culture, historically lower charge-offs than many peers.
Okay, track record matters.
It does. And second, You're betting on the impact of this very explicit de-risking strategy they just announced. That $8.1 billion swap from SFR loans into zero credit risk agency MBS. That should, theoretically, give them cleaner credit metrics through the rest of this cycle compared to those peers you're shorting.
So the thesis is cleaner credit plus the strategic pivot plus the buyback equals a valuation gap closing faster for WaFd than for the troubled neighbors.
That's the idea. The plausible part is that WaFd has strong capital and a clear plan to defend its balance sheet. That's the relative value angle. The outrageous part is, well, timing any regional bank trade right now, especially betting against the prevailing short sentiment. But it's a bet on specific execution and defense.
A very interesting, provocative thought indeed. That nicely wraps up our deep dive into WaFd Inc.
Yeah, I think the key takeaway for you, the listener, really is tracking that Build 2030 plan. Keep an eye on that non-interest-bearing deposit ratio. If they can actually hit that 20% target by fiscal 2030, that will be the proof point for whether they've truly closed the gap.
Absolutely. And remember, everything we discussed today is based purely on the company's earnings call and materials. It's not advice. Always, always do your own research before making any investment decisions.
Definitely.
If you have follow-up questions or another earnings call you want us to tackle, just let us know. Thanks for tuning in.